Hey folks, welcome back to Chapter 18. We did Section 1 last week. This week we are going to do 2 and 3. Real quickly, if you look over at Quizlet, all of these key terms are defined. I think we're going to start today right here with the bull market. Last week we ended with penny stocks, I believe. All right. So we're going to classify and describe the type of stock investments. We're going to look at sources of information for evaluating stocks. Most of them are on the internet. We're going to discuss a few factors that affect stock prices, such as earnings and earnings per share, projected earnings, and PE ratio. And then we're going to compare some investment theories. Some folks still use the newspapers. I prefer the internet. Okay, the Wall Street Journal, the Philadelphia Inquirer, the Daily News, they all still have business sections where you can get stock prices and read articles about stock information for evaluating stocks. Basically, we're all going to be investors. Most of us, like I said, we go to the internet, and I covered these on the next page. You also have places where you can subscribe. All right, there are investment surveys and Mergent's Handbook of Common Stocks. You can still subscribe to them. Most of them you can get online now. Okay, so rather than get the paper, most people just get them online, along with corporate news publications. And like I said, all of these now are just published on the net. Occasionally, you will get something in the mail from the corporation. It might be a proxy statement or a prospectus. This is where I go to evaluate my stocks. You can also go to Investopedia, Google Finance, The Motley Fool. There are literally hundreds, maybe thousands of these stock quotes where you can find your stock quotes. Apps, you can get an app for your phone, or you can visit web pages. What is a bull, or what is a bull market? A bull is a speculator who expects the future rise in prices of securities. So he thinks the economy is going to go up, all right, and earnings are going to go up and stocks are going to go up, and he's going to sell them in the future at a higher price. We got this term from the bull. The bull tends to throw its victims up in the air, so there you have that upward motion. And conversely, the bear is a speculator who expects a future fall in stock prices. He does an agreement to sell securities at a future date at the present market rate, hoping to make a profit, or he shorts, all right, S-H-O-R-T-S, shorts a stock in a good market. So the bear will stamp its victims down to the ground. Okay, so bull up, bear down. All of these influence the price of a stock. The price of a stock fluctuates, on a minute-by-minute basis, but most investors will look at the current yield. That is a percentage. You should know what that is. If a company's not paying a yield, it might not be in his favor. Take a look at the total return, which is the yield plus the stock appreciation. Earnings per share is very important. You want a company to be making money, earning money. Operating at a loss is a zero or a negative. A lot of companies operate that way, hoping eventually to turn a profit. Take a look at the PE ratio. We did a short video lesson on that last week. The PE ratio is real simple. It's the price of the stock over their earnings. If there are no earnings per share, you're going to see an PE ratio of 0 or not applicable, because division by 0 is undefined. All right, so if you see a PE ratio of 0, that's going to be pretty risky. It just shows you that the company's not making any money. Projected earnings, you want to look at multiple sources for that. Of course, a company is probably going to say, we're going to make money, but take a look at what some other investors say and other analysts say about their projected earnings. So you can actually, look at these numbers and come up with a decision on which stock to buy and how to buy it. So these are the investment theories, okay? And what I want you to know about these are in the discussion question at the end of the chapter, all right? And they simply are three. I'm going to ask you to give us, pick one and tell us why you would use that in your current market portfolio. The fundamental theory assumes that a stock's real value is determined by looking at the company's future earnings. If earnings are expected to increase, then the stock price should go up. Fundamental theorists look at the financial strength of the company, the type of industry, the company it's in, and the new products and the state of the company. So they really look at the company. They look at the fundamentals of the company. The technical theory is based on the idea that a stock's value is really determined by forces in the stock market itself. Technical theorists look at factors such as the number of stocks bought and sold over a certain period of time, or the total number of shares traded. So this is simply supply and demand of the stock itself. All right, and that's what technical theorists do. The efficient market theory believes that the stock price movement will be random. All right, or it's a random walk theory. This theory declares that all investors have considered all of the variables, all of the available information on the stock as they make their decision. All right, so this is kind of like a combination of the two, but the price movement is random. It will go up and down, fluctuate, if you will. So to round this out, we're going to explain primary and secondary markets and describe the ways to buy and sell stocks and evaluate long-term and short-term investment strategies. You've heard a lot of these names. The securities exchanges, that's a key term. All right, what a security exchange is simply where you buy and sell stocks. They compromise the stock market. So there is the NYSE, New York Stock Exchange, the NASDAQ, and if you don't know the abbreviation, it's the National Association of Security Dealers Automated Quotations. And this was founded by the National Association of Security Dealers back in 1971. So that's where that acronym comes from. When they automated the system, to be able to get the quotes automatically, they upgraded it. They called it the NASDAQ so that you could trade on the NASDAQ. Chicago Board of Trade, there is a London Stock Exchange, Paris, Berlin, and there are many more, and they comprise the stock market. These are key terms, primary and secondary markets. If you want to buy common or preferred stock, you have to go through a brokerage firm. In turn, that brokerage firm must buy the stock for you in a primary or a secondary market. In the primary capital market, investors buy directly from the issuing company. And think initial public offerings or IPOs. That's where they take place in the primary market. That's when a company goes public for the first time. It sells new stocks and bonds for the very first time. Investors can buy on that market. In the secondary market, that's when investors trade among themselves through a securities exchange. So there are ways to buy and sell stocks. All right, that's probably a question that you have. How do I go about buying these stocks? You can go to a full service brokerage firm. It's a lot of money. Their commissions are very expensive. If they take a percentage of your money, that is money that will not be invested into the stock market. It will be invested into their wallets. Okay, so full service brokerage firms are good. They will advise you. You don't have to make your own guesses. However, they will take this bigger percentage and they'll charge a fee. Discount brokerage firm, well, there's the word. That means they're not going to charge as much as the full service brokerage firm. The big difference in all of these is the commission. All right. You can decide to trade your stocks online at this point in time. I think we all can open up a E-Trade account and go ahead and just, call up a broker on the phone who will take your call and he'll trade whatever stocks you want to trade. He will not advise you. He will simply take care of the transaction. He'll still take a small percentage, but he won't take as big a percentage as the full service brokerage firm. Beware of the practice known as churning. All right, that's when your broker continues to call you up and offer you stocks, and that you should sell your stocks at a regular interval and keep buying and selling and buying and selling, because on each buy he makes a commission and on each sell he makes a commission. So beware. There are some types of orders when you call your broker. You can tell him what type of orders you have. All right, you can have a market order, a limit order, or a stop loss order. This is also called a stop order. Market order is a simple request to buy or sell a stock at the current value. All right, so you call up your broker, you say, hello, Scott, this is Tim. I want to buy 100 shares of Kellogg's at $50 a share. Quite literally, the conversation's over in about 30 seconds. Now we may go with a limit order. All right, and this is kind of a form of protection, if you will, or you can use this as a strategy. You agree to buy the stock at a price up to a certain amount. When you're selling, you limit your order to ensure that you will sell at the best price and not below a certain price. So here's an example again. If you place a limit order to buy Kellogg common stock for $34 a share, the stock will not be purchased until the price drops below 34. If you place a limit order to sell the Kellogg stock will not be sold until the price rises to 34 or higher. All right, so it's kind of a strategy where you can limit the upside and limit the downside. Stop loss order is usually when you put in a floor. Okay, yes, a floor, a bottom level. All right, say that you buy that Kellogg's at 100 with a stop order of 75. So let's say the Kellogg starts the week out at 100 and just keeps dropping and dropping and dropping and dropping and dropping. At some point it hits 75. You want it to sell at that point so that if it really goes through the bottom, you are at least protected, and that's why it's called a stop loss order, because it stops your losses. And more and more people are using computers. I mean, I do, to make securities transactions. All right, so here are some investment strategies. You can buy and hold. That's exactly what it means. You buy the stock and you never sell it, quite honestly. Dollar cost averaging is what we did with the stock market game. We bought a little bit of stock, 25,000, then we bought 25,000 more, then we bought 25,000 more over a period of 4 weeks, rather than just investing all 100,000 on one day. That limits your risk over the short term and in the long term if you do that on a yearly or semi-annual basis. Direct investment and reinvestment plans. If these companies kick off dividends, you can invest them right back into the stock. All right, so instead of receiving cash for the dividends, you receive another chunk of stock. It's a good technique. Short-term techniques, short selling and buying on margin. If you borrow money to buy stock, you are creating yourself a huge hassle. If you short sell, you're basically playing the casino. I wouldn't advise it. If you know that a stock is going to report some bad earnings and you want to get into day trading, you simply get on the night before earnings, you buy a whole bunch of the stock at today's prices, you borrow the stock at today's prices, and then when the stock falls, you have to say it's a contract for them. They have to buy it back at today's prices. So as the stock falls, you sell it back for a profit. It works, believe it or not. It's kind of like playing the casino. This is the last slide, and then I'll let you go. For an economy to grow and for the standard of living to improve, the business and government must invest. This is our recession and our trough, and then our peak, and then a recession. But the trend line, is this red line, and it must always keep going up. Maybe its slope changes, right? Maybe it doesn't go up at such a rate, maybe it will change, but it really, for the standard of living to improve, we have to invest, and we do. All right, so your last question is that I already covered it. Stockbrokers are trained and licensed to manage your portfolio. Given this expertise, why is it risky to allow a stockbroker to act on your behalf without consulting you first? All right, so that's on Schoology. Thanks a lot for coming in for chapter 18, section 2 and 3.